Hi guys, it's Stock Curry, and as the fallout from the FTX collapse continues and lawsuits start to get filed, a lot of people want to know whether influencers can be sued for promoting FTX. I'm going to give you the answer in today's video, so let's get into it. The CEO who helped Enron through their bankruptcy proceedings is now the CEO of FTX and is helping FTX through their bankruptcy proceedings. And today, he outlined a number of key issues with how FTX was run. The first thing he said is that there was a total lack of financial and corporate controls. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. In other words, the CEO is saying that this is worse than Enron. He said slipshod accounting will require forensic analysis. I do not believe it is appropriate for stakeholders or the court to rely on the audited financial statements as a reliable indicator of the financial circumstances of these companies. In other words, the CEO is saying that FTX fraudulently reported their financial statements, and the auditing that gets done by these accounting firms is really just checking to see if all the numbers line up, and they're checking to see if the financials were reporting according to the generally accepted accounting practices, or GAAP. They're not digging into the financials to see if they're accurate or not. They're just seeing if the reporting was done in the correct way. And that essentially is what the new CEO is saying, is that while these were audited and they were reported in the correct manner, the actual numbers were completely false and fraudulent. A standard aspect of any venture capital investment is a due diligence period, where books are opened and audited financials are shown to prospective investors. Ray, the new CEO, his assertion is that the financial statements for many of FTX's subsidiaries are unreliable, and it raises fresh questions about the diligence performed by some of the world's biggest venture firms. Now, when it comes to the question of whether or not influencers could be sued for promoting FTX, one of the biggest concerns that a lot of people had is that they say influencers should have known that FTX was fraudulent. However, if some of the largest investment firms in the world did not know that FTX was fraudulent, it would be a very difficult case to make that an influencer who's just making YouTube videos or is on Twitter or Instagram or whatever could have possibly known that FTX was fraudulent. Another issue the new CEO found was that a lot of personal items were paid for by company funds. In the Bahamas, I understand that corporate funds of the FTX group were used to purchase homes and other personal items for employees and advisors. I understand that there does not appear to be documentation for certain of these transactions as loans, and that certain real estate was recorded in the personal name of these employees and advisors on the records of the Bahamas. This is illegal in a lot of different ways, because when you're running a business and you want to provide a benefit to one of your employees or contractors, you can do that with company funds, but that has to be recorded as either a loan to the company or it has to be recorded as part of that employee's pay or compensation, and then the employee would have to pay taxes on that. And in this particular case, it does not look like any of those things were done. It just looks like company funds were used to buy personal stuff, and that's completely illegal, even in the Bahamas. The new CEO also said that emojis were used for expenses. Now, I don't really care about this. I mean, if FTX wants to approve company expenses with the use of emojis, whatever. It's not very professional, but at least there's accounting for it. Now, the biggest red flag here, and probably the biggest problem, was this major advantage for the Alameda Research Company. Unacceptable management practices included the use of an unsecured group email to access confidential private keys and critically sensitive data. Okay, so FTX's security sucked. It's way worse than we could have imagined. The absence of daily reconciliation of positions on the blockchain. So they basically had no accounting practices whatsoever, and FTX themselves probably did not even know what the value of their cryptocurrency assets was. The use of software to conceal the misuse of customer funds. Well, that's straight up fraud. The secret exemption of Alameda from certain aspects of FTX.com's auto liquidation protocol and the absence of independent governance. Now, this was the big major problem. This is actually what brought down FTX and Alameda research. In crypto trading, liquidation is the same as a margin call, where a leveraged position is closed out by an exchange due to a dramatic shift in the underlying asset's price. The way it's supposed to work when you are doing derivative or margin trading in the cryptocurrency world is that once you lose your initial investment, that position is supposed to be closed out so that you could never lose more than 100% of the money that you put in. So let's say you were leveraged 10 to 1 on a cryptocurrency investment. Let's say you put in $1,000, you're leveraged 10 to 1, so you're now able to buy $10,000 worth of a cryptocurrency. Well, if that cryptocurrency were to drop by 10%, so it went from $10,000 value down to a $9,000 value, your $1,000 investment is now gone. That $1,000 has been lost. And auto liquidation would close out that cryptocurrency investment. It would sell it for $9,000 and end it so that you can never lose more than what you actually put in. However, in the case of FTX, while every other derivatives trader was auto liquidated, Alameda Research was not auto liquidated. And as a result, Alameda Research was allowed to lose more money than they had actually invested. The new CEO summarized saying that he had no confidence in the balance sheet statements of Alameda, FTX, or their subsidiaries. So now that we understand a little bit more about the fraud that went on behind FTX, let's talk about a lawsuit that was just filed and whether this lawsuit and future lawsuits have any chance whatsoever of succeeding in court. Larry David, Tom Brady, Shaq O'Neal, Steph Curry, and others were named in a class action lawsuit which accused everybody of defrauding investors. The suit also claims that FTX's yield-bearing accounts represent unregistered securities under federal and Florida law. So there are essentially two accusations in this lawsuit. The first accusation is that FTX's interest-bearing accounts were unregistered securities, that these interest-bearing accounts should have been registered under Florida and federal law as registered securities before they were sold to the actual public. The second thing the lawsuit alleges is that the celebrities who promoted FTX did not disclose the amount of money that they were paid in order to promote FTX. So let's talk about whether or not this lawsuit actually has a chance of succeeding in the United States. While a wave of lawsuits over FTX is expected, investors are going to face some legal hurdles. The lawsuit, which was filed in Miami federal court on Tuesday, claims FTX founder Sam Bankman-Fried fraud and celebrities engaged in deceptive business practices by promoting unregistered securities. Now, the problem is that while some courts have ruled that certain cryptocurrencies fit the legal definition of securities, the issue remains unsettled. Further complicating this is the fact that cases against FTX, which is based in the Bahamas, will be made more complex by the fact that U.S. securities laws generally only apply to domestic transactions. Since FTX was based in the Bahamas, a case could be made that these transactions took place through the Bahamas. In that case, Bahama law would be appropriate and U.S. security laws would not be relevant in this case. Further, it is an open question whether U.S. securities laws apply to interest-bearing crypto accounts like those offered by FTX. The U.S. Securities and Exchange Commission, or SEC, has recently alleged that other high-yield bearing accounts constituted unregistered securities. So, based upon the precedent of the SEC, it does not look like this lawsuit is going to be successful. It looks like it's going to be shot down because the lawsuit alleges that these securities were supposed to be registered when the SEC precedent shows that no, actually, cryptocurrency interest-bearing accounts are unregistered securities. So it doesn't look like the lawsuit's going to go forward on that part of the case. But remember, there were two parts of this lawsuit. And the second part alleges that celebrities did not disclose the amount of money that they had been paid. The lawsuit filed on Tuesday did not name FTX as a defendant, but instead targeted individuals. The reason that is so important is because cases against FTX and related companies will be paused during bankruptcy proceedings. But cases against individuals who have not filed for bankruptcy may be allowed to go forward. And the crux of the celebrity endorsements is that Tuesday's complaint alleges that such promoters violated Florida consumer protection law by failing to disclose that they were paid to endorse the company. Now, as you're going to see here in a minute, it's not enough just to disclose that you were paid to endorse a company. You also have to disclose the amount of money that you were paid to endorse a company. And the question now is, if these celebrities have been sued, can influencers who are on YouTube, Instagram, Twitter, TikTok, can they be sued also? Now, the short, simple answer to that question is yes, an influencer can be sued. Here in the United States, you can sue anybody for any reason. You don't need to have a reason to sue somebody. Now, that doesn't mean you're going to win, but theoretically, you can sue anybody you want to. The real question that we want to know is, if you sued, would you win that lawsuit? So let's take a look at this a little bit closer. Recently, Kim Kardashian's SEC settlement showed that influencers working with brands could face fines. The SEC announced that it had reached a $1 million settlement with Kardashian over a 2021 post promoting the crypto asset Ethereum Max. Although the post mentioned the often used hashtag ad, the agency said Kardashian should have also included that she was paid $250,000 for the post. So Kim Kardashian made it clear that she had been paid for promoting Ethereum Max, but she did not disclose the amount that she had been paid, and the SEC says that was illegal. The federal securities laws are clear that any celebrity or other individual who promotes a crypto asset security must disclose the nature, source, and amount of compensation that they received in exchange for the promotion. Over the past several years, several celebrities have settled with the SEC after promoting cryptocurrencies without proper disclosures. Now, Alexandra Roberts, a law and media professor at Northeastern University, said professional influencers like Kardashian know not to skip disclosures and should be penalized when they don't. However, when it comes to micro influencers, such as those on YouTube, it should be the responsibility of the company hiring them to make sure that they're educated and that the disclosures are in place. Now, this is not settled law. Obviously, the SEC can still go after anybody they want to, but it's pretty clear that if you promote a cryptocurrency or stock security on YouTube or Instagram, Twitter, TikTok, wherever, you have to disclose Not only the fact that you were paid, you also have to disclose the amount that you were paid. That said, it is important to understand that the majority of influencers are not celebrities. They're passionate content creators who have built an engaged community based upon shared values. Those influencers who have worked to build relationships that emphasize transparency remain credible. So, as far as the SEC is concerned, influencers will probably not get in trouble if they fail to disclose the amount of money that they were paid in order to promote a cryptocurrency security. This does not, however, mean that all influencers are off the hook. If influencers did something that was clearly illegal, then they will still be charged by the FCC. The United States Securities Exchange Commission has filed a lawsuit against a prominent crypto influencer, investor, and entrepreneur, Ian Balina, over an initial coin offering, or ICO, dating back to 2018. The SEC accused Balina of purchasing $5 million worth of SPRK tokens from Sparkster Limited and receiving a 30% bonus token payout before he started promoting it on social media. He did not disclose that he was given an incentive to promote the ICO. Again, the influencer was charged with not disclosing that he had been paid to promote this cryptocurrency token. Now, this is very different from influencers being charged in clear fraud. The U.S. Securities and Exchange Commission filed a lawsuit a few months ago in federal court against 11 individuals alleging securities violations related to a $300 million crypto Ponzi scheme known as Forsage. Now, in the case of Forsage, these cryptocurrency influencers had actually created the token and were illegally promoting it to the people that they were influencing while at the same time dumping it on the open market. In this particular case, it was a clear Ponzi scheme, a clear defraud. So we're not talking about influencers in this case who created a cryptocurrency token and then sold it to the people that they were influencing, knowing full well it was worthless. We're really talking about influencers who were paid by a company to promote something, but they didn't disclose that they were paid, and they did not disclose the amount that they were paid. Now, you might think that this is a sure bet. You can go ahead and sue influencers for not disclosing the amount of money that they were paid to promote FTX. But there is one problem with trying to do that. When a person is paid to promote a security, they must disclose the amount they are being paid. And I really want to focus on this word security. A security is a cryptocurrency token or stock. It could also be an option. A security is not a brokerage firm or an exchange. A security is also not a high-yield interest-bearing account. So even though if an influencer was paid to promote a cryptocurrency token, or if an influencer is paid to promote a specific stock, they must disclose that they were being paid and the amount they were being paid. An influencer does not have to disclose that they are being paid to promote a brokerage, an exchange, or a high-yield interest-bearing cryptocurrency account. So the laws are pretty clear that influencers cannot be sued for promoting FTX. Influencers cannot be sued for promoting FTX's high-yield interest-bearing accounts. Influencers cannot be sued for promoting Gemini's Earn account or BlockFi's high-yield earning accounts. These do not fall under the required disclosures for influencers. So hopefully that answered your question and it's very clear to you. If you still have questions, go ahead and put them down in the comments below. And if you want to learn how to trade cryptos and stocks and options in a profitable way without being swung over by all these influencers that some of them are promoting some pretty shady stuff, I encourage you to come join my coaching program where I will teach you how to do your own due diligence, your own fundamental analysis, and your own technical analysis so that you can learn how to trade these stocks, options, and cryptos. And you're not just buying whatever some YouTuber is telling you to buy. You're actually able to go out there and do your own research and figure out for yourself if the investment is a good investment or not. If you want to learn how to do that so that you can protect yourself and become more knowledgeable and experienced trader, then I encourage you to join my We Profit Day and Night coaching program. You can go on there and schedule a call with an onboarding specialist who will explain the whole program to you. And you can read more about that and sign up at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, I encourage you to share this video with your friends and family so that they will know what's going on as well. And make sure you hit the like button and subscribe. And if you want to know more about the fallout of the cryptocurrency collapse and how it affects you and your stocks in crypto, make sure you watch the last video that I uploaded here.